Hello, and welcome back to Scale to Exit with Alejandra Santos. Another great episode with another great guest. And I am so thankful you're here today with me. And if you're new into the Scale to Exit podcast, welcome, welcome, welcome. I love having you here. Thank you for stopping by for your weekly dose of insights and strategies and tips from other amazing professionals that have been through the trenches with founders or founders themselves that have exited their business. So I'm excited you're here. If you have come to the podcast before and you're coming back again, thank you for stopping by. Please, everybody that's here, make sure you like, share, subscribe. And if you would like to, please also comment on the podcast. And so today's guest is somebody that is in your corner. If you are a business owner that is trying to scale and he has tight cash flow, do not want to go and ask investor for money, and you want to use your assets for, to bring some extra cash, well, then he's your go-to person for that because he works with non-traditional lending solutions that leverages collaterals like POs, inventory, equipment, and accounts receivable that can relieve you and then can give you some more cash. So also, if you don't have any good credit as well, you should contact him. And I will put in the show notes his information. That way you can connect with him on LinkedIn. So Marshall Lebovits leverages over 35 years of lending experience to assist growing companies with obtaining working capital when too much cash is tied up in receivables and inventory, and with equipment financing when making capital expenditures. So many of his clients are fast-growing companies in a variety of industries who lack access to capital for reasons including short time in business, hyper-growth sales, customer concentration, weak cash flow, and highly leveraged balance sheets. So Marshall clients always have B2B accounts receivable, inventory, purchase orders, and equipment that can be offered to a lender as a collateral for repayment of a loan. So it's really great to have somebody like Marshall in your corner because, like I said, traditional banking makes it really hard for a business owner. I know because I've worked with you guys, but having people like Marshall really alleviates you on like an emergency, or if you need to run payroll, or if you need to cover some marketing expenses, whatever it is, the situation that you're going through. And he's going to come into the podcast and also educate you guys on different things and metrics that you should be seeing when signing a deal. Okay. So without further ado, I'm going to go ahead and bring him in, and I will see you on the other side. Well, thank you for coming, Marshall Lebovits, to Scale to Exit. I am so excited to have this conversation with you. You are an expert when it comes to lending and asset-based lending and non-traditional lending for emerging companies or companies that are scaling and they don't have really good, presence yet to go to a traditional bank.
Right.
So I'm excited to have our conversation here to enlighten the audience and business owners and everybody out there that's listening that there is an alternative way of funding their business, and it's with Marshall. So let's dive in. Marshall, what leads the passion that got you to have this career?
Yeah. Well, first of all, thank you for including me. I've known you now for a couple of years, and I'm always so thrilled to have the opportunity to talk to you. So in my career, I've worked with many of the world's largest commercial lenders and also have served as an independent loan advisor to small business owners. So back in 2016, I transitioned from commercial banking in search of my next professional challenge. And a colleague within the Better For You natural product sector suggested that I leverage my knowledge and expertise to help growing companies and raising capital without relinquishing their ownership shares. So around this time, I also experienced some vertigo, and the medical advice indicated that reducing sodium intake could alleviate the symptoms. So this led me to start examining nutrition labels extremely closely. And so when I considered my colleagues' suggestion and my own health related insights, it became clear that focusing on promoting healthier products across um, a variety of industries was a great career direction for me. And so currently I work with companies a lot across a lot of different industries, but a particular emphasis on the better for you consumer packaged goods sector.
So now you're very dived into the better for you consumer sector, right? That's where you're basically going with full force. And you have
That's most of my business,
Mhm.
although I'm working with staffing firms and
Okay,
manufacturers and
okay.
IT companies, but CPG probably
Mhm.
makes up about 80% of my customer base.
So what is when does the CPG founder comes to you,
Mhm.
and what is something that they can do before coming to you? That way they can obtain, I guess, more leverage in order to get a better deal.
First and foremost, they can make sure that their financial statements are accurate and timely. I can't tell you how many companies that I've talked to over the years who need funding tomorrow, but it's going to take them 5 weeks
Yeah.
to put in front of me basic financial statements.
Yes.
So that's advice number one. And the list could go on, but I'll give you one other bit of advice. And I think the second bit of advice I'd give to a company is to know who you are. In other words, what do you look like to a lender? Right? Do you look risky? Do you look like you've got top line growth? Do you understand your cost of goods sold, your margins? What is your overhead? What's your order to cash cycle? Know who you are. Because
Mhm,
if you don't know who you are,
mhm,
then you're going to find it much more challenging to convince a cost effective lender to want to extend a loan to you.
mhm, mhm. Those are some really good points. So first, have your financials ready,
Mm-hmm.
because and that's a common one that financials are only done for tax reasons, and then throughout the year you don't really know what's going on in your business. And then the second one really is know your risk profile when it comes to asking for money, and then know your stuff, right? Like know your cost of goods, like you said, your order to cash, your receivables, your inventory turnover, like all the metrics that you probably will need to assess them for a loan or a stream of money. Can you walk us through a scenario where using this kind of non-dilutive debt helped the founder
Mm-hmm.
preserve their ownership during growth?
Absolutely. So I'd like to tell you about one of my two clients, which I used funding for to that helped them catapult onto the Inc. 5000 fastest growing private companies list. And so one of those companies, I arranged an asset based line of credit backed by receivables and inventory, and they were a beverage manufacturer. And that helped them grow their revenues from $15 million to over $45 million in less than 4 years.
Mhm,
It was a revolving line of credit, it tripled in size, and it enabled them to raise much less equity, which is very important to shareholders counting on an exit.
mhm,
Most recently, I funded for the same company a multi-million dollar sale leaseback on all their manufacturing equipment, once
mhm.
again, protecting their shareholders from further dilution.
Okay, so I love that. Now let's go back a little bit. What kinds of, you said you just mentioned two really good
Mhm.
asset-based lending. So what other forms of asset-based lending do you provide? And then what kind of terms can people see? And can you maybe explain what asset-based lending means?
Absolutely. So, asset based lending is really a type of funding where, in the event of a default, the lender is primarily focused on the collateral value of the assets in the business as the
Mhm,
way to recover its loan balance, which would be both the outstanding principal and the accrued interest.
mhm,
And assets that one might consider, or a lender might consider for that loan would be purchase orders,
mhm,
accounts receivable, inventory, equipment, and real estate. And while it's an asset that can be leveraged, uh, intellectual property is typically an asset that can't get leveraged until you've got a company that's generating a lot of cash flow, because only then does the intellectual property become truly valuable.
Mhm. Okay, so that's really good to know. So basically, asset-based lending can be a collateral, kind of like your receivables, your
Mm-hmm.
inventory, any real estate property, any
Mm-hmm.
commercial property that you may have. Does asset-based lending also count the personal credit score of the owner, or does it also look like how many years you've been in business and how much do you have in top line revenue?
Um, the personal guarantee of the personal credit profile of the guarantor is
Mhm.
not considered all that much in asset based lending. They're really looking solely to the collateral
Okay.
and top line growth. It matters only in the sense that some lenders focus on certain revenue size companies and
Mm.
not others. They might go for companies with revenues up to $50 million, or maybe they're doing asset based lending for companies with $250 million to $5 billion of revenue. So that's really the only time that revenue size comes into play.
Okay, interesting. So what kind of like terms have you seen lately, especially with the market, like what's going on with the economy and the volatility and uncertainty in the market? What are the terms that are being released for founders?
Yes. So let's look at that from two different perspectives. The first perspective being what type of advance rate can you get against the collateral value of those assets? And so with receivables, you can borrow as much as 85 to 90%
Mm-hmm.
of the collectible value of a given invoice. With respect to inventory, you tend to see 50% of the lower of cost or fair market value on inventory. Purchase orders, you can get up to 100% of cost of goods sold. Equipment financing, you could probably achieve anywhere from 100% of the cost of new equipment to, if it's used equipment, you could probably see something in the, as high as 80% of fair market value. But, those markets, vary. And on real estate, you could see probably anywhere up to 70, 75%, maybe a little bit higher on the value of the real estate.
So the
And
advances are high then. They're not,
so,
yeah, I'm
right,
seeing. Mm-hmm.
exactly. But depending on risk, a lender might choose to lower that advance rate. Now, let's talk about interest rates for a second. And these are all very much um, specific to unique circumstances, right? So, on receivables financing at the low end, you could see rates in the high single digits. But depending on whether or not you're using invoice financing or factoring, I could also see rates as high as 20 to 30% on an APR basis. Um, Inventory financing, again, at the low end, similar amounts, and you would see inventory financing up into the low 20s. Um, Equipment financing, it varies because those tend to be companies that have stronger cash flow. And so you're able to get lower rates. So those would give you an idea. But it's also, I tell companies, don't only look at APR,
Mm-hmm.
because APR can be manipulated. And APR might not reflect that you're only going to use the money for a very short period of time when it comes to short term working capital. And so I alternatively suggest that they compare the actual dollar cost of the interest expense to the cost of goods sold, or rather the gross margin that they're going to be supporting in the sale of product, right? So if you're selling $100,000 to Costco and your gross profit is $50,000, even if you've got a high APR on the cost of money that you borrow against that receivable, it still may only be a couple of $1,000s to fund that receivable for 60 days, if that's how long it takes to collect. So you're still left with hundreds of thousands of dollars of gross profit, which you can then use to reinvest in your business or pay other bills.
Mm-hmm.
So APR is interesting. It's not the only thing I want my clients to look at.
Okay, that's actually a really good point and a really good example. So basically, it's really the time as well of without paying that debt, right? That the
Mhm.
unpaid debt. For how long are you having that? That's also something that you have to look for.
Exactly.
Because if the APR is just for 6 weeks or whatever, 2 months, it's not APR for a full year, which makes a huge difference, right?
Right.
Mm-hmm.
It's an interesting benchmark and an interesting measurement, but it doesn't always tell you the true value to your corporation for borrowing that money.
For borrowing that money. So for anybody out there that's scaling fast, but
Mhm.
obviously they don't have enough cash in the bank, can we explain to everybody what is non-dilutive debt mean and why is it more advantageous than going out there requesting investor capital?
Right. So non dilutive financing allows owners to secure funds without giving up equity,
Mm-hmm,
unlike venture capital, which
mm-hmm,
involves exchanging your shares for investment dollars.
mm-hmm,
Lenders only want one thing, they want to get repaid with interest. The
mm-hmm,
venture capitalist invests at their own risk, but
mm-hmm,
their goal is to share in your ultimate success.
mm-hmm, mm-hmm. Mhm. And so back in the day, right, this was more of a common practice. Like our ancestors, how they created businesses was more with non-dilutive debt than getting equity financing. And now it's becoming more of like I want to get venture, VC money rather than going for non-dilutive debt. What do you think has changed from there to now? And why is it good to implement both?
Well, I think you use different types of funding for different types of needs.
Mm-hmm,
And for me, the way that you create your capital stack or your balance sheet in
mm-hmm,
your funding is
mm-hmm,
really driven by the third statement on your three financial statements that your CPA or accountant would
mm-hmm,
create.
mm-hmm,
The P&L tells you, okay, well, what did I do and how much money did I have top line and bottom line? The balance sheet reflects all of your assets and liabilities of where you are today. But that cash flow statement says how I need to raise my money. If
mm-hmm,
you're making profits, then you have money to reinvest in your business. If you're not making profits and you're cash flow negative, that's the kind of money that you need to fund through venture capital or equity or dig into somebody's pockets. The
mm-hmm,
next section of that cash flow statement is changes in working capital and how that consumes cash.
mm-hmm,
That is my world.
mm-hmm,
That's the world of you should borrow on a non dilutive basis to
mm-hmm,
take care of funding requirements that are short term in nature and that maybe have a revolving need and that can be scalable. It's a great way to raise money on a non dilutive basis. The third area is what other things did you invest in? And that means that you invest in plant and equipment, real
mm-hmm,
estate.
mm-hmm,
Those are the kinds of investments that you could potentially fund through long term loans, again, which are typically non dilutive. So
mm-hmm,
that third statement is your roadmap. It tells you how to raise money and it tells you the nature of the structures that you should be considering as you
mm-hmm.
go out to market to seek either debt or equity.
Mm-hmm. Yeah, I love that you put a lot of different scenarios out there, and that you spoke about the most hidden one of the statements, which not everybody talks about. Not everybody even looks at it, right? Most people are more concerned about the balance sheet and the profit and loss, but the middle one is the combination of everything together. It's actually the story of the business. And it actually tells you where to put your money and how much money do you need.
Mm-hmm.
Um, and I love non-dilutive debt, and I've seen it as a strategy too, is that you can bridge a fundraising round going from C to Series A on a non-dilutive debt. And sometimes that also works because that way you don't have to do a bridge round, right? You don't have to create a new, just to like get more equity from other investors. Or the way that it can also work is um, I get funding from investors, and I've seen it this way as well as a strategy. And then I go apply for non-dilutive debt, and because I have more cash in the bank and I have a longer cash runway, then I can get more money as well. What do you say about that?
Well, what I say is that the money that you tie up in receivables and inventory is money that you can't use to grow your business, right?
Mm,
And you really, 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 when it's a short term need, a fluctuating need, that's a non dilutive working capital problem. And
mhm,
that's the last thing you should go out to market for and ask for somebody to write you a check in exchange for your shares.
mhm, mhm,
I really think that, again, when it comes to working capital, go get some non dilutive revolving money. And I'm not an advocate of borrowing money um, to fund losses. And I'm not an advocate of borrowing money um, as a bridge, so to speak, where you don't know where the bridge leads to, right?
mhm.
Bridge funding is great when you know you've really got a bridge to get to the other side as opposed to a pier, right? Where it's you're going to get to the edge of that pier and you're going to be down in the ocean.
Yeah,
So again, there's a lot of tools, and it's that cash flow statement that tells you, okay, this is your path, and this is pointing toward the options that might make the most sense.
yeah, yeah. No, I agree with you 100%. It's like some of the strategies, and this is the reason why I invited you to the podcast, is because most people are putting so much weight into equity financing, but they're really forgetting about the non-dilutive debt that's out there. And that's really how our grandfathers and their parents did a business. Like that's literally the backbone of America have been through debt, right? That's why we are in such a capitalist country, right? But I mean, not left to say that everybody's keep forgetting about this side of things, and they're going more to the left side, which is the VC funding. And I think that you're leaving away your power by going to VC funding with non-dilutive debt. You can actually have leverage more power, like your clients that
Mhm.
scaled and they enter that in 5,000, right? That's amazing.
Yeah. Mm.
Yeah,
I
yeah.
would love to say that that was, I get all the credit, but it was just one of their tools and, making sure they got to that level of success.
Yeah. How do you what kind of companies do you usually clients you usually work with? Do they have like weak cash flow? Do they have like a concentrated customer base? What is a good candidate for asset-based lending?
A good candidate for asset-based lending, and who the people who are my clients are companies with less than perfect credit profiles. If you've
Hmm.
got a perfect credit profile, you should be able to go to a bank and get debt financing.
Hmm.
For everybody else, there are alternative sources of institutional money that
Hmm.
can provide you with loans at,
Hmm.
in many cases, very cost effective rates
Hmm.
that help you achieve your objective without having to give up your shares.
Hmm.
So there are a lot of tools out there, and it's a increasingly larger or increasingly growing market of sources of funding. The private credit markets have exploded, and that means there's a lot of non-bank money that's available to lend to growing companies. But my clients typically are not consistently, if at all, generating positive cash flow. They are highly leveraged. They may have customer concentrations. They may have weak gross margins or non-optimal gross margins. They suffer from a lot of challenges, but there are solutions. And the key is to take your time and to find out what those are so that you can make smart decisions.
Okay. So that's really smart. So okay, so I want to like reiterate like which one is your customers, because for everybody that's out listening, like you don't have to have a perfect credit score. I know that people get bummed because they don't have a perfect credit score,
Mhm.
and that's okay. Like there's alternatives like what you're doing out there that can help you grow your business. What are, besides the APR obviously, and the the term of the loan, what are other metrics or any other things that people should look out for to getting a really good, like the best deal that they can have?
Good question. Now I've got to think of a good answer. Um, um, the path to profitability is important, right? Because a lot of my clients are struggling, So are your gross margins um, improving, and are they standard, or how do they compare to the benchmarks in the industry?
Mhm.
Beyond that, some of the most important measures that my lenders look at are the days sales outstanding, right? How long is it taking you to collect your cash? And if it's taking you longer than your trade terms of net 30 that you're offering to your clients, the answer is why? Is it
Mhm.
because that's a norm for the industry? Is it because you have extended trade credit to less than creditworthy debtors, customers,
Mhm.
yourself? Is it that you're doing a bad job of managing your credit and collections operations? So, my lenders want to know how they're going to get repaid, and they're going to look into a variety of benchmarks to determine whether or not you're a good credit risk for them to take on.
Mhm. 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 Yeah, that's so when somebody, so if the lender comes and says, okay, I have a lot of concerns, like to disburse this loan, what are some ways that customers, the business owners can come in and navigate their concerns?
Yeah, there's probably a lot of things, and it really depends on the specific risks that the lender is seeing. That'll determine which mitigants you can offer them. But here's a couple of the mitigants in asset based lending. It
Mhm.
could be lowering the advance rates that you receive
Mm.
on your collateral,
Mhm.
it could be setting concentration limits, right?
Mhm.
You've got 60% of your business coming from one customer, they may say, well, we'll lend you against your receivables, but
Mhm.
we're going to cap our exposure to 30% on that particular debtor. Um, they may employ shorter loan terms. The lender might also ask for financial covenants, right? Very, very tricky one, and you've got to pay attention to that one very carefully. Um, Also, personal guarantees, right?
Oh, okay.
While your credit may not be strong, the lender may still ask for personal guarantees. And I'd like to talk about that for just a second, because people go, well, I don't want to give a personal guarantee because I don't want to put the rest of my family at risk.
Mhm.
Right? I don't want them coming over for my house. I don't
Yeah.
want them coming after my personal bank account. And
Mhm.
what I tell them is, in the world of asset based lending, and I can't tell you this 100% guaranteed, but my experience has been that lenders want the personal guarantee, not because they're going to pursue it in the event of a default, but because they want you locked in. They want you really engaged in the event that there is a default under the loan and they have to foreclose. They want to make sure that you're going to be there to help them collect on the receivables, to help them liquidate the inventory or the equipment. They
Mhm.
want to know that you are laser focused 24 hours a day, 7 days a week on them getting whole. And that if you didn't have a personal guarantee, it would be a situation of you drove the car into the ditch, you said, here are the keys, go get the car yourself, and good luck to you. That's not what they want. They want you by their side, helping them get to 100% collected on the loan.
Mhm. So in your wide experience that you've
Mhm.
been doing this for such a good time, like very long time, what has been a scenario, if you can share? You don't have to share names or anything, but what has been a scenario where the company couldn't meet their loan obligations, maybe because of the market or the economy, or maybe because of tariffs? I don't know. What is something that they did differently that get them out of the gutter, or what would happen in the outcome of that company?
I've got to tell you that I've never had a client go into default
Okay.
where the lender wasn't able to collect out on the loan.
Okay.
And I, I'd like to tell you that it was because I'm smarter than everybody else. I'm just not so sure. But here's what I think I can tell you is that I'm very, very focused on matching up borrower risks with lender appetite.
Ah.
And if you've done a good job of matching up the borrower and the lender, there really, especially in asset based lending, there
Mhm.
really shouldn't be a great risk of loss on the lender's behalf in the event of a default, right?
Mm,
Unless somebody's done something wrong, which
mm,
happens.
mhm.
But I will tell you that in situations, even when my clients, the limited situations where they may have been asked to find a new home, none of the lenders have ever taken a dollar loss.
Okay, gotcha. So you basically are the one that's analyzing the risk profile of the business owner versus the risk profile that the lender can support, and then match those. That way there is no loss.
Right.
That's easy.
Well, we hope to avoid losses, but
Yeah,
even the lender won't, and they shouldn't rely on me to do their due diligence. But in
obviously.
that initial phase of facilitating introductions,
Mm-hmm,
those introductions are based on my having years of lending experience and talking to the lenders on a regular basis and say, what are you interested in lending for, and what circumstances work well for you, and what loans are you really attracted to, so
mm-hmm,
that you have eliminated in those early discussions whether or not the loans are a good fit. Right. The
mm-hmm,
last thing you want to do, I always, here's an interesting anecdote, because I've had these conversations with clients before, and I tell them, don't necessarily take the lowest rate on a loan. You may have three offers. Look very carefully if that lowest offer is significantly lower than anybody else. And the reason being is that the lender may then have really underestimated the risk in the deal. And if they underestimate the risk in the deal and something goes wrong, they may be very quick to call the loan and foreclose, as
mm,
opposed to somebody who says, I'm charging you a little bit more because I anticipate these kinds of risks and I'm
mm,
comfortable with those risks. And if
mm.
something goes wrong, I may invite you in for a phone call to discuss how you're going to work through a difficult situation, but I'm not going to quickly terminate your loan because I anticipated those kinds of risk.
Mm. So there's
So
more flexibility working with the business owner in the event that happens.
there may be more flexibility by
Mhm,
somebody who has properly priced in risk than
mhm,
somebody who was a little bit too aggressive in
mm,
their rate,
mm.
and again may have underestimated the risk in the deal.
Oh, so there's an art to lending. There's an art to fundraising and art to lending as well.
Yes, right. That's why I'm hopeful that I won't be replaced by AI anytime soon.
I don't think AI is going to give anybody those first, the network or the connections or the analysis that you're doing for
I
people.
like to think not, but you never know.
Maybe you can create an AI for you and then, have AI Marshall. That,
That's yeah.
that,
I'll put that on the chalkboard here next to my desk and add that to the list of things to do.
that could be cool. I would be like, I'm going to ask AI Marshall right now
I know.
with my clients. Okay. So you've seen it all. You've been through the trenches. What mistakes do founders, business owners make that unintentionally sabotage their exit, and how can smart debt help avoid that?
Uh, yeah. So I would say that there's a couple of things, and that regard to an exit. I'll give you a couple of examples. One is many simply use inappropriate types of debt, which can be costly. And really, it's not just the cost; it will force them or put them in the position of misaligning their company priorities. So they'll do things which are driven by the need to repay the debt, as opposed to running their company in the right way. So I would say, again, borrow money repayable from operational cash flow, avoid borrowing to cover losses, use revolving funds for scalable working capital, matching up that cash cycle, secure long term loans for fixed assets like equipment and real estate. But let me talk to you about another kind of non financial um, uh, issue that comes up when it comes to exiting. And this is really a data issue. And it's not just your financial reports, it's, do you know the drivers of your business? Um, last I would say for a couple of years, I was working with not an IT, a healthcare staffing company. And that was one of the issues and over and above that I was helping them with beyond raising working capital is to, who are you? Who are your customers? Where do you have concentration risk? Where do you have risk relative to the kinds of contracts you've signed with them and how they process payment? Um, do you have geographic risk? Do you have risk of, of how you're serving that client relative to your competition? Um,
Mm-hmm.
do you understand the profitability of each of your different product lines? And does that vary by geography? So
Mm-hmm.
there's a lot of things that you really have to dig down deep
Mm-hmm.
that show that you understand how your company operates and its impact on financials,
Mm-hmm.
right? Which drives value, right? Because what we're trying to do in an exit is drive value.
Mm-hmm.
And it's the old saying, if you don't know where you're going, then any map will get you there.
Mm-hmm.
It's the same with your data. If you don't understand your data,
Mm-hmm.
then you really don't know how to drive your car, your company in a way that maximizes enterprise value.
Yeah, and I love that you said that you really brought up a really good point, which is a data point. We are living in a data-driven society era, I
Mm-hmm.
would call
Yeah.
it, and it's accessible to all of us. However, it's not about the data itself; it's what we do with the data that makes a huge difference. And I see all these AI companies that are startups that are going out and they're fundraising over 3 billion valuation, $30 million rounds, whatever it is.
Mm-hmm.
But at the end of the day, are you really solving the problem that it's like, what am I doing with that data rather than I have the data, right? Because you can have the data all day long. Everybody has data. But what are you doing with the data? And I think it's also a problem that comes back to the operators of the business, not only the business owner, but also part of the team.
Mm-hmm.
And a lot of that falls under the CFO side. And I see a lot of CFOs out there, and I say that because I am in the industry, that they don't leverage the data the way that they need to be leveraging the data. They
Right.
use more the projections and where we going forward. Yeah, but have you been diving into the top line? Like, what is driving the top line? Who is there? Who is buying? How long ago are they buying? How are they behaving later on?
Mm-hmm.
Like, they don't really look at those things. So I think it's a problem of both, right? The business owner, obviously they do need the help, the support, but the support doesn't really know what to do with the data. And
Right.
then also what you're saying, yeah, like it's a huge problem. It's a huge problem. And when it comes to exit, you should know everything that's going on your business, and it should be transferable as well, not just you, but transferable.
If you're
So,
exiting, or if that's your goal one day, then from very early on, honestly, you should be talking to investment bankers and requesting their insights into what drives economic value.
mhm,
Because likely they'll say, yeah, top line's nice, gross margin's nice, but before we take you to market, we're going to have 5 years of history on
mhm,
these, 25 drivers, these
mhm,
25 ratios. And it could be
mhm,
revenue ratios,
mhm.
productivity,
Yeah,
profitability.
yeah,
There's all kinds of information that may or may not be in your QuickBooks or whatever your accounting system is that you need to be sure that you're collecting, that you're cleaning it on a regular basis to make sure that there are no anomalies, that there's nothing in there that got miscoded,
mhm,
that perhaps wasn't cleared out properly.
mhm,
You got to have control over your data. So, as
mhm,
important as the lending or the borrowing side of it is and the capital
mhm,
stack, when it
mhm.
comes to maximizing your enterprise value, your data is extremely important.
Extremely important. Not like what you said. I mean, we're not even there yet because the financial data doesn't have a lot of data. It just gives you a snapshot of what's going on, but it really doesn't give you anything else. Like you really have to drill down with like really drill down and make the ratios that you're speaking about,
Mhm.
create those formulas and those process flows and those tools in order for you to obtain that information on a regular basis, right?
Right. It may take a lot of time to go back and
Mm-hmm.
extract the information on a long term historical basis. And because the investment bankers, whoever's going to be helping you facilitate a sale of your company is going to be looking for 3 to 5 years of data. And you need to have it so that not only can you extract that data, so that you can keep it current on a going forward basis, on a monthly basis,
On a
right?
monthly
You
basis,
can't
yeah.
say, I'm just going to do this on a, quarterly or twice a year basis. You really need to make sure that you're tracking this data and creating it on a regular basis, because it shouldn't be something you just give to your investment banker. It should be something that you use as a basis for making decisions
Or
on
making
how to
this.
run your company.
Agreed, yeah. This is why I said exit strategy doesn't come when, oh, I'm decided to sell my business. Actually happens from the beginning, because you have those metrics are the cornerstone of making decisions for the health of your business. So it's not like because I want to sell. No, it's because it's going to drive a lot of the decision making that happens in your regular operating activity, not
Right.
just in the moment of an exit or a liquidity event, which I love that you said that. So for anybody that's out there that do have a business, how can they turn their operating assets into something, or working capital into in as they grow their business into something that they can leverage for asset-based lending?
Yeah, so we've talked about it quite a bit. It's what I do for a living. It's taking those operational assets, the inventory, the receivables, the equipment, and turning those into money, right?
Mm-hmm.
Because the money that you have tied up in those assets, that's money that you can't use to grow your business and maximize your enterprise value. It's
Yeah.
that simple. Otherwise, you're going to always be starved for cash. You may
Mm-hmm.
not be able to invest in new equipment. You may not have the money to maintain your existing equipment so that you get the highest optimization out of it. You may not have the money to protect your intellectual property, which could
Mm-hmm.
come back to haunt you in an
Mm-hmm.
exit situation. You may not have the money to invest in hiring new salespeople to open up a new territory or to offer a new product line. You may not have the money for branding or to
Mm-hmm.
rebrand.
Yeah.
So, all of those assets, all of that cash tied up in receivables
Mm-hmm.
and products sitting in a warehouse
Mm-hmm.
is not money that you're using to increase that enterprise value. And you should be
Okay.
looking at ways, non-dilutive ways, to take back some of that cash to invest in your business.
Okay. Yeah, no, I definitely agree with you on that one. I've seen a strategy that, when businesses have a very costly balance sheet, just an example, like they have a manufacturing loan from China, so they're leveraging that loan to bring product, which becomes very costly. In your experience and opinion, do you think that getting into another type of asset-based lending in order to make the balance sheet look better is a good strategy?
Well, I think the answer to that is it can be a good strategy, right? Because the lender, or a potential buyer rather, wants to know that you've done a good job of optimizing your capital structure.
Mm-hmm.
I'm not sure I understood the question or the tie into taking a loan from your um, supplier. Did I miss something?
I'm just giving a scenario, like a
Oh, okay.
scenario. Mm-hmm. Yeah.
Okay. So, look, I actually have a client that took a very, very large loan from its Asian supplier. And it was a problem in the sense that, as a lender looking at their working capital needs, the concern was that if something went wrong with
Mm-hmm.
that supplier over in Asia, then they
Mm-hmm.
could foreclose on that loan and take the
Mm-hmm.
company down,
Yeah.
right? So whether it is a supplier providing extended payment terms on payables, uh,
Mm-hmm.
everything gets taken into consideration by a lender and probably a buyer of your company as well. They
Mm-hmm.
want to know what could happen that
Mm-hmm.
could cause any risk to the ability of a company to maintain itself as a going concern.
Mm-hmm. Mm-hmm. Yeah, I agree with you. So it is kind of like a good strategy. It could be a good strategy to really improve, obviously, how your working capital looks anyway. So
Mhm.
if sometimes because of some startups getting, bad deals, and then finally someone else comes in and looks at the balance sheet and restructures the debt, and then makes it look better and more promising, right? And pays less on APR, or it has more cash in their bank because of
Mhm.
that. So it could be a good strategy. What other scenarios have you seen that are out of the box where people come in for asset-based lending?
Wow. So asset-based lending has solved a lot of interesting problems for my clients.
Yeah.
I'll tell you one. It was someone asked me for a success story where there was a crisis. I don't
Mm-hmm.
know if this is all that interesting, but we're going to run with it.
Yeah.
So I had a client that I mentioned that was in healthcare staffing, and they were providing travel nurses to hospitals for intensive care and the emergency room.
Mm-hmm.
And I would say about 5 months into COVID, when they were growing exponentially, their bank, which was a major global bank, came to them and said, "We're terminating your line of credit because we're getting out of the healthcare business."
Mm-hmm.
Um, that was incorrect because it was a major global bank and it wasn't exiting the healthcare business. It was that my client was banking with the local branch, and the local branch had limited ability to underwrite a sophisticated loan structure, right? You should always be careful if you're dealing with the local branch, because if they don't know what they're doing, then it could be more problems for you than it provides benefit. So always make sure that you're banking with somebody that knows what they're doing. But they lost their line of credit, and they've got nurses that need to be paid every Friday, but they don't collect their receivables for 60 to 75 days because of the way that the healthcare system works and
Mm-hmm.
how hospitals pay their bills.
Mm-hmm.
So, how are you going to make payroll next week if your bank line has been terminated and frozen?
Mm-hmm.
So, I was able to arrange with them, or for them, a bank line with a regional bank
Mm-hmm.
that understood their business, gave them a fantastic deal.
Mm-hmm.
It scaled, it revolved, and it helped them grow from $10 million of revenue to $50 million in about 24 months. The line of credit
Mm-hmm.
increased from $1 million up to five,
Okay.
and it gave them plenty of money to grow their business without any dilution.
Okay.
So
Wow.
just a really great story. I mean,
Wow.
asset-based lending, the lender probably would not have made a loan to them
Mm-hmm.
without tying it to receivables,
Mm-hmm.
because it's just, they were hypergrowth. Banks really don't like hypergrowth. It's
So
scary
yeah.
because
So
they
like,
like looking backwards as opposed to forwards.
yes, it's supposed to forward. So this is like really good to say that you do have to have different kinds of debt tools in your
Mhm.
toolbox. It doesn't matter if you're hyper growing or you're in the initial stages of scaling. Like the moment that you can get a revolving line of credit, get maybe an asset based, get different kinds of tools in your toolbox, right?
Yes, know what the tools are that are appropriate for you,
Hmm.
and always make sure you're developing the relationships early on so
Hmm.
that when you do need someone, you're not in panic mode.
Yeah, yeah, correct. Yes, because the alert and the reactivity that happens when you cannot pay your employees is horrible. Like, it's just so much stress already just to thinking about it, right?
Can you
Um,
imagine? I mean, not making payroll to nurses and
yeah,
have them walk off the job because they didn't get paid, and you're in the middle of the COVID crisis,
yes. Oh, wow. Okay.
right? You're in the fall of 2020 when everything is going nutty.
Yeah,
And can you imagine if those
yeah,
nurses had walked out of the ERs and the ICUs
mm,
because their staffing agency wasn't able to make payroll?
yeah, yeah. Yeah, that's a bigger one. That's so, I just love that you talk about those scenarios because it just left to say it's really good to explain to everybody out there that's listening that uh, as a baseline, it doesn't have to happen in a reactive moment, but it can also be a proactive, like proactively now speaking. Now you have this line funding your payroll, right? and it actually protects you for the future because you don't have a institution froze you again, right? Like now it's working with another type of institution that are a little bit more flexible. So
It's very similar to what we're doing right now with tariffs, and everybody's going,
mhm.
oh, supply chain and
Yeah,
redundancy and
yeah,
backups. And
yeah.
the chief financial officer, whoever is responsible for funding the company,
Hmm.
should always make sure that they have backup and redundancy built in and
Hmm.
ready to roll. I mean, you may not pull that trigger
Hmm.
immediately, but you
Hmm.
also don't want to be caught in a situation where you're without liquidity because you haven't thought far enough in advance.
Hmm.
Last year there were a couple of situations that came up. One was a what I call a fintech lender went out of business because it turned out that there was something wrong in their algorithm, and so they were evaluating loans wrong, and all of a sudden they had a lot of losses. And then there was another company that offers an early payment portal where you can negotiate early payments of your receivables. And they decided they also wanted to be a lender. And they found out they didn't know how to lend. And so they started cutting off liquidity from their borrowers. And I got a call from a trusted advisor who sat on the board of a company, and he said, we need help fast. And they explained to me what happened, and the company showed me their existing loan documents, and I said, do you know and understand the terms that you have? And they said, yes, we think we're borrowing at 13% or 12.5%. And I said, you're borrowing at twice that rate.
Wow.
They didn't not only did they not understand the terms of their deal, but they were partnered with somebody who cut off their liquidity. I was able to actually find a replacement lender for them in very short order, and we actually ended up with the real rate that they thought they had. So you could look at it as you get them half the rate, or yeah, that's what the way I look at it is I actually cut their funding rate by 50%.
And just explain to everybody what the difference is of everything.
So
Yes.
there's a lot of ways that lenders um, are able to market their products and the cost of those products without it being completely transparent.
Yeah.
And what they do is they will combine uh, true interest expense with origination fees, with ongoing fees, with commissions, with back end fees, with all kinds of little extra charges, which are meant to enhance their return on the transaction. Um, and honestly, most borrowers can't figure that out. It's very difficult if you don't do it every day and you don't know how to evaluate these types of structures. You'll, not because there's anything wrong with you other than you lack that experience and
Hmm.
expertise.
Hmm.
Um, and sometimes it's good to have a trusted advisor by your side who
Hmm.
can help you understand those things. And all of my clients are explained to the best of my ability what the actual effective rate is in a deal, including all the fees.
Hmm.
Um, and like I said, it's not only what the APR interest rate is, but
Hmm.
how much does it cost you in absolute dollars and cents in
Hmm.
interest and fees, and what are the risks that you would encounter due to the structure of the deal that could create problems for you as you go down your journey of being an entrepreneur, of being a
Hmm.
founder. What I don't want my clients to do is focus solely on APR and costs
Hmm.
and ignore as I like to call them, the potholes in the road of your journey that, if you're not careful, could enable you to break both your ankles,
Yeah. So
right?
I,
And keep you from reaching your destination.
yes, and the reason why I bring that question up is because I do have seen that there is not a lot of people have that kind of knowledge, and it's okay because why would you have the kind of knowledge? I mean, it's not
Yeah.
expected, but it's also okay to go, like you said, get an advisor that does have the kind of knowledge to explain that to you because like what your client or the that what we're going through, that they said they were paying 12%, but it was actually double that, right? To prevent those kind of scenarios.
Yeah. Their actual out-of-pocket costs were the same, but their effective interest rate was double.
Doubled, correct. Yeah. And that makes a big difference. I mean, like that, perspectively speaking, that makes a huge difference on someone's mind when they're.
I think so. Look,
Mm-hmm.
I tell people a lot of times that the even when you know the real cost of money,
Mm-hmm.
it's unlikely something that you're going to brag about at Thanksgiving dinner. So again, look at the cost relative to your gross profit and look for what it helps you accomplish strategically.
Mm-hmm.
Because you may look at it and say, the money was
Mm-hmm.
really expensive. But not only do I still have a lot of my gross profit left over to run my business, but it helped me land a strategic account,
Mm-hmm.
which now I can use that as a springboard to go
Mm-hmm.
land another strategic account,
Mm-hmm.
or to obtain enough manufacturing volume where all of a sudden I'm meeting the MOQs more easily at my contract manufacturer, and now I can drive down my cost of goods sold and also increase my margins. So it's not just about the actual APR. You have to look at a lot of different things.
Yeah. Yeah. And I love that you're educating people on that, because that is really good information. I mean, how can you go ahead and get a better loan deal if you don't really know those big metrics, right? Like, what is my actual effective interest rate? Don't the AP, everything that comes, the
Mm-hmm.
fees, the origination, all of it, right? Like all the baked in. Yeah, that's
Mm-hmm.
really good information. Okay, so now let's go to personal questions.
Oh, okay.
Yes. What does self-care mean to you, and how do you incorporate that into your daily routine?
So for me, self care means eating a healthy diet, getting enough sleep, and
Going to the
trying to get
mountains?
what's that?
Going to the mountains? Because you go
And
to the
trying to get
mountains.
some type of exercise on a daily basis. Yes, absolutely.
I love it, because I know every time we talk, you always show me your photos on the mountains in Colorado and all the adventures. So I know that the next question, I don't know if the answer is what it is going to be, but I have a hunch. Would you rather be at a mountain, an ocean, or a lake, and why?
Yeah, so I'm happiest outdoors, so all of the above.
Okay.
I just want the opportunity to be out and exercise and get fresh air and be out in nature and see beautiful sights and just have a reminder of how life is much, much bigger than my small little world. It's
Oh,
just when you're out there in front of a big ocean like I am with the Pacific Ocean, or in a mountain that's 13, 14,000 feet high, or even a smaller mountain, right? The idea is we are so small relative to the world
yeah.
and circumstances, and it is again a way to keep perspective and a way to remind yourself to be grateful each and
Yeah,
every day.
I agree. I think that being in nature is one of the best ways to ground yourself and to
Mm-hmm.
really find that peace and mental clarity and
Mm-hmm.
balance in everyday life. I am a lake. I live the ocean life. Now I'm living the lake life. We'll see which one I like more. I don't know, but anything nature goes for me. If you had the opportunity to meet someone and sit next to them at dinner, who would that be, and what would you ask them?
That's a great question. And I would love to invite my 25-year-old self to dinner and ask me why I didn't seek out mentors for both career and life um, a lot more.
I
Right?
love that.
It's all about you could get political figures, great artists, um, philanthropists, but the truth is, I'd really like to talk to myself and go, what the hell were you thinking?
Now, are you a big mentor for a lot of people?
I've been a big brother.
Okay.
and I still maintain a relationship with that young man. I was a big brother to him when he was between the ages of 8 and 11, and now he is in his mid to late 30s and has 2 kids of his own, and we still talk. We still talk and chat, and when I'm asked for advice, I provide it, but not unless I'm asked.
Oh, I love that. So, what would kind of mentors do you think that you would have, that you would ask yourself that you didn't get when you were younger? What would it be? Sales? Would it be marketing? What was it?
I think it wasn't specific to sales or marketing. It would have been specific to how to dream bigger about a career, how to take advantage of opportunities, how to know who is a valuable connection for me and how to create value for them, right?
Okay.
Because it's got to be you want it to be a two-way street. So, there are a lot of things that I think I could have done a better job of, had somebody been able to push me a little bit more in ways that I may not have understood that were in my best interest from a career perspective. And honestly, the same thing in life.
Mm-hmm.
We make mistakes because we think we know everything,
Mm-hmm. I
uh,
agreed.
or
100.
we're stubborn, or we're not listening. We're not listening to hear and understand. We're listening so that we can plan our next response.
Yes. Yes. Agreed. I 100% agree with you because mentorship is really important. I'm actually looking for mentors right now in different areas that I want to get better at because otherwise, how am I going to get better? Right? I
Oh,
mean, I
I
can watch,
know
like you
someone
said.
for you.
What?
I know someone for you.
Oh, nice. You already have someone picked for me. You?
Well,
You?
no, not me. No, 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 no. Uh, uh, Someone I've known for many, many years who just retired at the beginning of this year was a partner at a CPA firm, and I had dinner with him the other night, and he told me he is mentoring younger professionals, and he said he's got one more opening.
Oh, okay. Well, send me the info. I'll see if we match, the profile matches and all of that. Yeah,
Okay.
definitely. Thank you, Marshall.
Yeah.
Okay, so
Okay.
before we leave, do you want to talk about something that I haven't asked you yet?
I would say that anybody should feel free to call me that wants a little bit of time,
Yeah.
because I do mentor in the sense that I talk to everybody and I see my job as one of educating founders and entrepreneurs.
Mhm.
And there's no cost, there's absolutely no obligation. And here's the proof of that. There was a company I met maybe back in 2021, and for 4 years, they would call me up and or text me and say, "We need to talk." I'd pick up the phone and I would give them advice, free advice on how best to fund their company, or more importantly, to help them understand the options they were considering. Because what I liked them and I thought they had a good product, and I didn't want them to make a mistake simply because I had an issue with needing to be paid, or, oh, is this going to lead to something for me? I gave them advice,
Mhm.
and they grew the company. In those 4 years, they tripled revenue. Right? Nice. And then they came to me in January and said they just received a uh, an approval from Target to launch their product nationwide in all the stores. And Target was going to really do some great things to promote their product, and they needed working capital. And that's when I was finally able to help them and lined up a revolving line of credit. But the truth is, I would have helped them anyway. I just My job is, okay, what are you looking at? Um, let's talk through it and
Mhm.
see if it makes sense for you. And I have companies that call me up all the time and they say, "Hey, I've already got 3 term sheets. What do you think? Can you
Yeah.
beat this?" And it's like, no, you've got a good deal and here's why. And I'm hoping that that creates some good karma for me. And one way or another, either the satisfaction of knowing I've been that mentor that I wish I had had, or that, maybe one day somebody will say, "Marshall, I do need you to help me right now."
When you're at dinner with your younger self, you should tell your younger self that how impact you're creating, because I do remember that I always had come to you to questions and advice, and you always give me advice in a really, really good way. You actually spend your time with me. So forever that's listening, Marshall is really legit, genuinely, authentically
Thank you.
just trying to really support all entrepreneurs and founders and business owners out there. So I can back that up 100%.
It's a challenging journey for everybody, and it can be a little less challenging if you have some good people in your wagon, so to speak, helping you out along the journey.
Yeah, agreed. And for everybody that's listening, where can they find you? I will put it on the show notes too.
Have them reach out to me on LinkedIn. Right,
Mm-hmm.
I
Awesome.
check it probably too many times a day,
Okay.
and but you can reach me either through LinkedIn, or if you want my email address, Marshall at funding911.com.
Okay, perfect. So I'll put it in the show notes. And it's been such a great pleasure to have you on the Scale to Exit podcast, Marshall, with your amazing, insightful information that you have given us. I think we should do an episode number 2 with you, just because there's so much information that we didn't cover. And why not? Why not do another one? There's always room
I'm
for
I'm
more.
always I'm always there for you. Whatever I can do to help you.
This is exactly what I'm saying. Marshall is genuinely, authentically, really there for everybody. So for everybody that's listening, thank you, muchachos. Adios. Hasta la vista. Bye.